Joel Greenblatt is one of the greatest investors alive today. And in his book, The Little Book That Beats the Market, he introduces something that he calls the magic formula. According to him, this magic formula, anyone can use it to beat the market over the long term. Of course, I decided to try this. I went through 50 companies that according to the magic formula I should be investing in, and today I'm going to share my experience with you. Whenever we hear magic formula or use this formula to beat the market, it seems too good to be true. But Joel Greenblatt in his book, he gave us several examples of why it works. And he gave us different limitations. For example, you can use 50 companies or you can select 30 companies. Some people might choose companies that have market cap of bigger than $10 billion, let's say, others less than $10 billion. So different limitations, but still, every time you use the formula, you beat the market. It is more interesting to know how it actually works. So in this formula, there are two parts, the valuation part, let's call it the multiples part, and also the efficiency part. How does it work? Is that you list all companies that you have, let's say in the United States, by their earnings multiples. So those that have a PE ratio of 1 will be ranked higher compared to, let's say, those that have a PE ratio of 20. And if one has a PE ratio of 1000, it is going to be much further down on the list. So you give number 1 to those companies with the lowest PE ratio, and you're going to rank them. And then you rank companies based on returns on capital. Let's say a company is ranked 3rd on earnings multiples and it is ranked 5th on returns on invested capital. It will have a total ranking of 8. And if another company has a total ranking of 15, the 8 would be a better investment according to this formula compared to the 15 one. I will suggest you read the book, you go for all the details. But just to summarize it, it is based on valuations, on earnings multiples, and based on returns on invested capital. The valuations part, it makes sense. You invest in companies that are cheap, that looks undervalued, that are trading at low multiples. But we all know that using just the PE ratio or just the price to book ratio, in most cases, it doesn't work. Sometimes you need to look at free cash flow. So that's one, let's call it a red flag that I saw in this formula. It is not always applicable because you need to know what the earnings mean. For example, you look at booking holdings. The earnings of booking holdings don't make much sense. It's better to look at free cash flow. Now let's come to the most interesting part, the efficiency part, the returns on capital. And you might have heard me say returns on invested capital. It is not the same. And here also, this is one very important concept, that the way that Joel Greenblatt calculates returns on capital takes the earnings before interest and taxes, the EBIT, divided by the capital of the company, which according to him is the net fixed assets plus working capital. So according to him, we need to ignore all the extra cash that the company is holding on its balance sheet. We need to ignore the goodwill, because it is only doing comparison between different companies. So if a company has a lot of debt, but it still is able to generate a lot of cash, it is still going to be shown as an efficient company. So it doesn't take into consideration financing, because in the EBIT, it's earnings before interest and taxes. So it doesn't look at interest at all. What I don't like about this part is that when you're looking at companies, I believe the financing too is important. If you're going to invest in a company, you want to know if it is properly capitalized. You don't want to invest in a company with too much debt, even how much cash it is generating. Because in the future, this company will need to refinance its debt. And if interest rates go up, maybe it is going to be hard for it to do so at the proper rate. But now if you want to be a defensive investor and you want to just invest based on this formula, then I think it might be a good idea to use that formula to look at companies. If they match it, then invest in those companies. Because really, a company that has high returns on capital and trading at low multiples, over the long term, you're likely going to beat the market. If let's say you invest in 30 such companies, you must be diversified, of course. But now if you want to be concentrated, then you need to go and do the deep analysis for each company. And I did exactly that, as I told you. Most of these companies are outside of my circle of competence. There are many companies, they are pharmaceutical companies, which I don't really like to invest in such companies because I don't know about the clinical trials, how much more money they have to invest. It is outside my circle of competence. And then there are companies that are cyclical, which I don't really like to invest in. They might look efficient, returns on capital might look great, it's because we are at the peak of the cycle. But if we invest at the peak, it might not be a good idea long term. Many of these companies have falling revenue, something I want to avoid. Just because they are efficient doesn't mean that it is a good investment. It also doesn't take into consideration capital allocation at all. So if a company is paying dividends, which I have to pay taxes on, compared to a company which is buying back shares, which I prefer, this formula doesn't look at that at all. So what I will suggest is that you can use the formula to find the companies. If you want to be an enterprising investor, you go through each company individually, you try to see if it fits what you want to invest in. And I did that, and I only got one company that fits my portfolio, and it's already in my portfolio, and that is Crocs, which is already 20% of my portfolio. So instead of me diversifying between those 50 companies, where I will have only 2% of my portfolio in each, I would rather buy one which I have more certainty on, and that is Crocs. That's just for me. That doesn't mean that you have to do the same thing. Maybe for you it would be better to invest in those 50 companies to be as diversified as just using the formula. If you're just using the formula without doing any further research, then it might be a good idea to diversify with 50 companies. But if you want to do the research, yes, you use the formula, but you go with each company first and try to understand if it fits your portfolio. And there are many companies that are going to be missed. I gave you the example of Booking Holdings because the way the earnings are calculated, this is not accurate according to me. So the formula will not include Booking Holdings. Foreign companies are not included with this formula. So you're missing out on most investment opportunities. If you want to know more why I say that the earnings of Booking Holdings are not accurate, I would recommend you watch this video next. Have a nice day and goodbye.